Well, Fed Chair Jay Powell in front of lawmakers again, this time testifying before the Senate Banking Committee after addressing the House Financial Services Committee yesterday. The testimony comes a week after the Fed paused its rate hike campaign, but Powell does remain hawkish, saying that we have a long way to go to tame inflation. For on this, we want to bring in Kevin Flanagan. He's WisdomTree head of fixed income strategy. It's great to see you here. So once again, Powell taking a hawkish stance, saying that the Fed might need to raise rates 2 more times in order to get a better handle on inflation. What do you think is necessary?
You know, it's really perplexing a little bit. We just had the Fed meeting a week ago. And, you know, here the chairman is talking about we may need 2 more rate hikes. And I kind of scratch my head. It's like, well, if you're thinking in that direction, is one pause really going to do much of anything to change your mind? Why not give us the rate hike last week, give us one in July, and be done with it? So it's kind of interesting messaging that we're getting from the chairman right now. I think what he's trying to do is just completely drive out of the market that rate cuts are coming anytime soon.
With that said, we did have Atlanta Fed President Raphael Bostok on Yahoo Finance yesterday, who talked about that lag factor. He's especially concerned about saying it could be up to 24 months until we see the full impact of this tightening cycle so far. How concerned are you about that?
Well, I mean, it's Volcker-esque, right? If you want to use the term, 500 basis points since March of last year. And something else that Powell has been talking about and maybe spooking him a little bit as well, even though he spoke quite hawkishly yesterday and today, is the tightening in credit conditions from the regional banking turmoil we've had, that is an ongoing process as well. So that's why I kind of get back to the notion of being a little perplexed. It's like, okay, if you're going to pause, then pause. Don't talk about appropriate for 2 more rate hikes this year. It's one or the other at this stage of the game. Really what it does is, I think, just send a mixed message to the markets.
Kevin, we have seen the labor market be very resilient up until this point. There are slowly starting to see some signs of the labor market cracking. Though, if we do see the Fed raise rates even higher from here, what does that mean for the labor market? And I guess, how are we still able, do you still think we'll be able to avoid a recession?
It's a great question, right? It's the recession we're all waiting for. And 6 months into the year, it's yet to occur. I mean, go back last year when we had the quote unquote textbook recession, but everybody said, no, look at gross domestic income, a different gauge for economic activity. And it's flip-flop. That's now negative while GDP is positive. But I think, you know, what's important to ask the question, maybe the Fed needs to ask themselves the question, is 1 or 2 more quarter point rate hikes really going to do it? I mean, you've already done 500 up to now. Is 1 more 25 or 1 more 50 basis point move going to be the thing that pushes the needle finally? I do think what you have done, however, is pushed out the timing of a recession, that if you were expecting one by now or third quarter, perhaps it's being pushed more into Q4 or a 2024 development.
Abroad, we did see the Bank of England today, as well as the Norges Bank, the Swiss National Bank, and then even Turkey today raised rates. I mean, that seems to indicate just how sticky inflation is globally. Does that, if you sort of flip the conversation here, does that in some ways show that the Fed is in fact leading the pack in tackling inflation?
Well, yeah, you know, I mean, I think they had been leading the pack up to now, and a lot of the central banks are playing catch up. And that's the question, is where do they lead from here? Is it the pause, or do they still have a couple more rate hikes up their sleeve? Do they pull a Bank of Canada, right, who that raised rates earlier this year, took a few meetings off, and then raised rates again? So we're data dependent, meeting to meeting, right? That's kind of the jargon we're hearing from the Fed, from Powell. And in that environment, what that does, it just increases or maintains an elevated volatility quotient, especially for the bond market, because to your point before, with each jobless claims number, each monthly employment report, we're going to be responding in the context of, well, does this mean a Fed rate hike, or is this the real pause?
Kevin, how should investors, though, be looking at the fact that central banks around the world remain so committed to getting inflation under control? When you take a look at what the Bank of England just did and what's happening right now in the UK, they're far from getting back to that lower inflation target that they want to see. How long could this fight potentially drag out?
Well, I mean, obviously they were behind the curve, tried to catch up, get out in front of it. It takes time. I remember Chairman Greenspan way back in the day used to call looking at inflation measures such as CPI as akin to looking in the rearview mirror. So you wonder, are they fighting the right fight still, or should they, to the point you made before, I think that Bostic was saying, the mechanism, the flow-through mechanism for monetary policy takes time. Now, there's other measures of inflation that aren't showing perhaps inflation coming down more than the official government measures. So that's the unknown. That's the uncertain quotient that we're dealing at this time.
Let's talk about how people should be positioning themselves in that uncertainty. From a fixed income standpoint, what do you like right now? Is it about treasuries? Is it about corporate credit? I mean, where do you think people should be looking at?
It's kind of twofold. I mean, we're asked oftentimes about duration. We'd rather be late than early to the duration party. I think the yield curve continues to point you in that direction, the historical inversion nature of it. I look to Treasury floating rate notes where you're getting yields, say, in the area of about 5.3, 5.35% with 1 week duration. So it's kind of income without the volatility. And we have seen a return to normalcy where yields in the high yield space are now 8.5%, 9%. So if you're looking for a core plus kind of measure as well, maybe with a quality screen, perhaps there's a place for high yield in your portfolio as well.
Kevin, when it comes to investment grade bonds, is there a place there for that in your portfolio? And I guess when should you start to look to add some of that exposure?
I'm sorry, what kind of bonds did you say?
Investment grade bonds. Is there any, I guess, people who are trying to get more of a defensive type of exposure here, given the fact that there's so much uncertainty, when should they be looking to add?
Well, I mean, spreads have widened out, so you do have some yield advantage over, say, straight treasury coupons for investment grade corporates. And if you do feel that the economy is ultimately headed towards a recession, then perhaps you'd rather be in investment grade credit than, say, sub investment grade credit. But, considering we're still waiting on that recession, labor markets are solid. I think you have enough cushion in the yields in the high yield market to hopefully avoid any kind of pratfalls moving forward.
And in terms of where your allocation should be, are we still sticking to 60-40, or is it a little more geared towards fixed income?
That's a great question. Well, we in-house, we have our models that tend to drift towards 75-25 in this new genre we've had in investing at this stage of the game. But, more and more, I think with income coming back into fixed income, you are seeing flows moving back into the bond market, right? These are some yield levels we haven't seen 15, 16 years, a generation of advisors, of investors that haven't seen before and are waking up to, as I mentioned, 5% in the treasury market, which is quote unquote considered right, kind of in the risk-free arena. And it's unusual for a lot of investors. They've not seen these kind of yields before. So we are beginning, I think, to see a different balance approach when we're looking at stocks and bonds.
All right, Kevin Flanagan, WisdomTree, head of fixed income strategy. Thanks so much.